Now let's take practical example. Currently Facebook is moving in an uptrend and is trading at $164.62. Now if your view is bullish for the stock and if you want to purchase 100 shares of Facebook, you will have to pay 164 multiply 100 is equal to $16,462. But if we see the options price of 165 call of Facebook Incorporation, see this is the option chain of Facebook, and if we take the expiration of 8th March, the current price of stock is 164.62 and the nearest strike is 165 strike. So if our view is bullish, we will see the price of call option. These are call option in the left side and in the right side these are put options. We will learn about the options chain and all these terms like expiration date and strike price later in the course, but currently just focus on this price. 165 call option price is $2.63 and it is the price for one share. It means if we want to buy call option of Facebook Incorporation, we have to pay only $263 for 100 shares. Now see the difference. When we are buying 100 shares of Facebook, we will pay $16,462, but if we buy one contract of call option, we will pay only $263. Now, if Facebook rises to $170 in the next few days, we will gain $500 because currently the stock is trading near $165. So, by investing $16,462, a profit of $500 will be only 3% return. But by investing $263, a profit of $500 will be 100% return. But in the next few days, if stock price falls to $160 from here, our net loss will be only $263. If we buy the call option of Facebook, that is the cost of call option contract. Whereas if we buy shares at $164.62, our virtual loss will be approximately $500. It means with option trading, when we buy option, if we are in profit, we have the right to realize the profit amount from the seller. But if we are in loss, we are not obligated to suffer that loss and let the options contract lapse. So this was a bullish scenario, but if we are bearish about the price movement of any stock, we can buy the put option of that stock. For example, this is 20th of February and CVS Health Corporation is trading at $64.22. Currently, the stock is moving in a sideways range, but as this was a gap down opening and this candle is trading near the lower band of this Bollinger Band, you can see Bollinger Band is expanding, so my view is bearish about the stock. So in a bearish scenario, we should buy the put option. But as Bollinger Band is moving in a sideways range, if there is a sharp fall in the prices because Bollinger Band is expanding and this was a gap down opening, then we can make good profit in put option. But if there is a sideways movement in the stock, we can lose our money in buying the put option. So we will take the next month expiry. This is 20th of February. We will see the expiration date of 15th March. So this is 15th March. Expiration date is 15th March and currently the stock is trading at $64.22. So the nearest strike are 64.5 and $64. 64 put option strike is trading at $1.46. So if we buy 64 put option, we will pay $146. So if on this expiration date stock closes below $64, then this strike will be in the money and we will make profit in this put option. So with option trading, we can make money in bearish scenario also, and if there is a fall in the prices, we can buy put option to make profit in downtrend also. Thanks for watching. I'll see you in the next lecture.